Hey everyone, welcome to the market review. This week I thought I'd take a step back and do like a high level overview of where we are with everything. And gonna start that with basically the macro situation, which is it is very unlikely that the war will end. It doesn't mean that we get escalation further than that, but even the current state, which is not war, not peace, is gonna finally catch up to us. And from that perspective, the combination of what's happening with the war plus weather, basically, like we have a historic heat wave in Europe, we have historic drought in Europe. You keep seeing news about the Danube drying up, basically. Romania shut down their nuclear reactors. I think Hungary is gonna do the same next week if things don't improve or something like that. Traffic on the Danube is getting hurt as well. On the Rhine, which is the most used continental waterway in the world, I think. So lots and lots of disruptions, and commodities will be affected. And we had a soft CPI this week, or not necessarily soft, but in line, and the market more or less like that, hike odds reduced for September. But I'm calling bullshit on that. And the reason is basically the combination of things as they are developing in the real world is is still saying inflation is here to stay. Like it's not necessarily saying that it will increase, although I think it will increase at some point in the future. But it's definitely saying it is not coming down at fucking all. And on top of this, we're coming into negative seasonality, meaning summer is the dull period where nothing really happens and demand is limited. When we get into fall and winter, we get a spike in energy demand, we get a spike in food demand, and everything basically starts escalating from here. And the Trump administration has been obviously trying to keep volatility down and keep everything down, like the constant job boarding, the constant releases of bullshit news that, especially for oil, have kept it down. I think this will stop working very, very soon. And just like a simple experiment, these are the top 20, 25 commodities in the world that I put here. I'll talk about each one of them individually, but let's add US inflation rate year over year, just like a simple overlay, and we look at where things are. So first of all, oil, obviously a high correlation with oil prices and CPI, and we had a small increase here, but again, it was very muted. It helped that we dropped the tariff increase from last year, so the why it seems that it's much smaller this time. A large part of that is because we had a tariff spike last year, and basically we started from a high base. And when you start from a high base, the rate of change is difficult to increase much more. Like if you had 10% inflation last year and now you had 8% inflation, it still means prices are increasing by 8%. But on a percentage basis for inflation year over year, the increase rate is smaller. It doesn't mean prices are going down. It means they are increasing at a lower rate. So this is kind of what happened here. The tariff inflation we got from last year is somehow helping us look like we have lower inflation this year. And the only difference is that the rate of increase is lower, but things are still increasing. So this is crude, this is Brent. Again, the correlation is here. Nat gas, summer period, it's a lull in nat gas consumption. We should be going up again as we near winter. This is July last year. Oh, this is July 2020, sorry. Oh no, well, let me go to last year. So this is August 1st of last year, and as we can see here, seasonality kicks in and we start going higher, and the top should be in January. So even though this is at lows, it doesn't really matter because it should be starting going up to seasonality moving forward. Europe is in a much worse state because we get our gas from the Middle East, or we a part of it comes from the Middle East, and we're already at highs going into seasonal negative catalyst basically. So it can only go higher from here. It will not go lower. And last year at the same time we were, let's go August of last year. Again, we were close to lows and we kept going lower until December and then a big spike. Now we are at the point where we are supposed to be at lows and we are at highs. So very negative from that perspective as well. Then we have these are New York crack spreads, New York Harbor US uh, what's the word? Diesel futures. And again, diesel is more important than oil, and diesel went up crazily, and the impact on inflation is not being reflected in the inflation numbers. So the longer crack spreads stay at highs, crack spreads being the difference between diesel prices and oil prices. Let me put this to a new scale so that it scales better. Then we have the crack index. This is the crack ETF for oil refiners. Refiners are going crazy because of crack spreads. And again, we should be seeing it go up as well. Newcastle coal, similar to nat gas, there is little demand during summer, but we should be going up soon. And UGA is the gasoline fund, which again exploded, and we should be seeing inflation follow it very soon. This week we had gold moving forward as well, started to go up. Precious metals are not that correlated with inflation, or not without a delay, but this is what we're seeing as well. On the other hand, we have copper, which is highly correlated with inflation and it's been going up for a while, but not being reflected in CPI either. Zinc, very similar to copper. ASRC, I mentioned this one previously when I talked about CLF, but it's at levels we haven't seen since the war, the Ukraine war. Aluminium, same kind of thing, highly correlated with inflation, but somehow this time this spike that we see in metals is just a blimp in the inflation readings. Nickel, and the one that is actually going down is this is iron, but yeah, it is what it is. Not all everything will go up. Lumber is irrelevant. This is cotton futures. So we go to the other part of this commodity list, which is cotton, and then we have this is sulfuric acid. And when we look at the charts, they look very bullish. They look like they're going about to break out and go to a new leg up on everything. And this is true for cotton, and it's true for all food commodity ones. So let's go back to the monthly just to compare better. And again, inflation seems to follow this very closely. And due to the drought we get in Europe, there is drought in the US as well. If you remember, like in April, May, there was like a month of 40 plus degrees in across India, basically everywhere, and again a negative aspect of that. And I'm sure we will not get relief from bad weather the entire year. So what we will see in all of the food commodities is they are all prone to break out and moving higher. So this is soybean futures, again, very good chart. Looks like a bottom here, looks like it's going to break out and move higher. Then we have this is rice futures, a similar look, bottom going higher, probably gonna do like a cup and handle here for a while and then break out and go higher. Something like this is what I would expect to see in rice futures. Then we have white sugar futures. This has been surging lately, and yeah, not a lot to say about this aside from what is clearly visible with the naked eye. Then we have wheat futures. So another aspect of the disruption is, aside from weather, we have Hormuz, we have Bab el whatever, the other strait in the Middle East, and then we have the Black Sea. And we keep we keep seeing news about what's happening with Ukraine hitting Russia, but there is very little news about Russia hitting Ukraine. And that's kind of the media narrative trying to hold up Ukraine, but Ukraine is getting hit hard. And what Russia has been focusing on is hitting their export ports, basically Odessa and the one at the Danube, and they have very little export capacity. So Ukraine's grain exports will be going away basically, and the Black Sea is sort of like the third major hub that is getting hit by war and is getting disrupted. So aside from this, France produces a lot of the grain in Europe, and it had record heat wave. Romania record heat wave, but the harvest already happened. Most likely it's going to affect corn. And then we have corn futures, which haven't really gone up that much quite yet. But still, this is the double bottom kind of waiting for the breakout. And when it breaks out, it goes like all the way here. So these are very bullish charts in my opinion. And unless something happens, we should be seeing them break out across the board. Then we have cocoa, again, bottom and went up. We have coffee features. We have palm oil, which surprisingly is very correlated with US CPI as well. But this is more like an Asia thing that we will see during fall, and that's kind of everything. And soybean meal futures. So all of these charts, while not necessarily going to new highs, tell the same picture. So it doesn't matter what food commodity we see here. They all have kind of the same chart with a base here, rounding base here, and preparing to do another big leg. And when the breakout happens, and again, it will probably like double maybe not this high, but it will double everything. So the narrative that inflation will be coming down, I think, is way, way, way too early, and most likely the Fed should be hiking when we go into the September meeting. If they do not hike, they invite these breakouts. This will happen most likely even without the Fed doing anything. But if they fail to get ahead of these moves, uh, I think it will be much worse than what we see here. So inflation is not beat. I think there's a high likelihood that we get a huge wave in the next 6 months because of the breakouts we will get in food commodities, because of economic conditions, the wars, weather, and so on and so on. So this is one side of the coin. Another one for oil specifically is we've had uh, SPR drawdowns, and we're getting to the bottom of what is possible to do through SPR drawdowns. And on top of this, uh, those SPRs have to be refilled. So this will keep oil prices elevated, probably like in the 70s at a minimum range for the foreseeable future. So even if Hormuz is back to normal, it will take like 2 years to refill the SPRs across the board, not just the US, but Japan, but Europe, and so on and so on. So this will keep a bid on oil prices. So I don't think it's possible that will see sub 70 oil prices in the next 2 years, something along those lines. Let's see what else did I have here. Yeah, that's kind of it on this side. Then I posted this a while back, and it's about seasonality. We all know that SPX has negative seasonality during fall. Like the biggest corrections and the most negative drawdowns we ever saw in the markets happen like in the August to November window, um, usually starting in September. And election years are some of the worst. Like it's almost guaranteed we get pullbacks during election years, especially if we had none in that year ahead of time. So, for example, in 2024, let's go to 2024 here. We had this one in June, and it didn't really give us much of a pullback during election. But when we do not, we generally get very quite big pullbacks. This is 2022. This is a midterm year. 2020, we saw a big double dip, 10% drop during election. So especially in years where we had huge run-ups, and this one we did, and we didn't really have a sizable correction to reset us, even though the narrative for the bullish side is that we did. We are still kind of going on fumes right now, and the expectation is that we will get a big pullback during the election. Then on top of this, we have the Trump wildcard element basically. Uh, as we get closer to the elections, I would expect Trump will do something to steal it because why not? So there's the potential to things to escalate very quickly and to get like a blow up. And all of this is happening basically with VIX at a cycle low here. Like we haven't been here since December 2025. So almost a 1 year low with potential to go even a bit lower for the next week or so. But again, seems unlikely that we will break below this level, like below 14, let's say. And this doesn't give us a lot of upside when we go up here. So all everything points to escalation. Everything points to volatility picking back up, which has the potential to give us a correction. And finally, when we go to look at the semis, like you remember last week, I talked about SNDK and the potential to break down and go like to 900. I don't remember where we were, maybe here or something. And my reasoning was the rally will not be fully over. Like if we had that pullback to 900, so let's say we would have done this, go to the 900 area. I said that we will not be fully corrected until fully bounced until we hit the upper Bollinger Bands. And what did we do on Friday? We hit the upper Bollinger Bands. And on top of this, this is like a 50% Fibonacci correction. Yeah, almost exactly 50%. So I would say this is done. And the chances are this starts going lower here. From the liquidity correlation, SNDK, this is exactly what's supposed to be happening. It's not going to be a full breakdown quite yet, more like a slow grind down in a range in this area here. And the breakdown should be happening like September into October. But if this is to persist, we have all the conditions met of this being the top of the correction, full 50% retracement into the upper Bollinger Band with unlikely chances of pushing it back higher. And aside from this, the liquidity squeeze continues. Like there are signs everywhere. We have even this week we had the Nvidia news about AI-backed securities. We had Intel doing a stock offering. Uh, Over the past couple of months, we had Google doing multiple bond offerings. We had Oracle bond offerings. We had Meta bond offerings. And these are just the big names. Like the small names are also doing this. It's not isolated, and I think it will only get worse. For fuck's sake, like why is MicroStrategy selling Bitcoin? It's selling Bitcoin because it cannot find buyers for whatever it wants to finance. So uh, in under normal market condition, MicroStrategy would never be selling Bitcoin, but it is. We have stuff like Mara, which is Mara and Riot, in case you didn't know, has pivoted to become AI companies and offer basically repurposing their mining equipment to compute towards compute, and they have been liquidated their Bitcoin balances. And again, it looks like this, but it's no longer a Bitcoin company. They're selling Bitcoin. So MicroStrategy is also selling Bitcoin. They would not be doing this if there was liquidity in the market that they could tap into. So they're not finding buyers, or they're requiring too much yield, and so on and so on. And this is true. It has been true for a while. When we look at socks, lower high, lower high. All the memory names are on lower high, lower high, lower high. Everything is lower high so far, and it seems very very unlikely that they can make new highs moving forward. Even when we look at Kospi, like you remember the news this week about Kospi that to be able to trade leverage ETFs, you would have to do like a couple of hours of mock trading to get like sort of like a license. This is equivalent to a trading license. Like you get your driver's license, you get your trading license to be able to trade leverage ETFs. All of this is just screaming that there is not enough money in the market, and the conditions that caused this last surge that we saw here are impossible to be replicated. It's just the same effect that we have in squeezes, like when we had a GME squeeze. Um, the conditions for this are impossible to replicate once it tops. Once the top is in, because IV is super high, so all of this is happens because of IV expansion. Turn these things off. Don't care. So all of this happens because of IV expansion. We begin from nothing, and then IV starts ramping up, and it causes the gamma squeeze, and more buyers, and more buyers, and more buyers, and more buyers. But once we topped, it becomes impossible to sustain because the IV remains super elevated, and if it drops, it crushes the call positioning that was bought near the highs, and so on and so on. So it's impossible to get the same IV expansion and cause the same kind of move up. It's always a lower high, and then lower high, and then eventually it fades for good. So we have the same conditions happening across the board in the AI uh, and semi-complex, meaning the expansion that happened here, it's impossible to replicate now that we have gone lower. They obviously the bounces are super huge, like SNDK specifically went up like 60%, I think. Semi SNDK is this 60%? 66%. So all of this has happened, but now it's impossible to replicate it. We even get like government is obviously drawing liquidity, but we have JPA intervention. Even countries are running out of money or ways to fund their stuff without spiking yields, and all of this points to stagflation. Now, I I've been saying this. What does this mean for SPX basically? And the answer is complicated. Because due to the commodity squeeze that I think is very close to hitting us again, and it's not necessarily hitting us. I, I don't know how to say this. Like I think commodities will become a safe haven, and this means rotation. So my expectation for the next for this summer autumn weakness period is that we will continue making a range. So this is not a big correction. It's only 8% from where we are right now. Yeah, 797. So this is not a big correction. It will just set the range that we are in possibly until the end of the year. Uh, and what I would expect and is basically doing this for the foreseeable future. Because the same way that we didn't really drop here is because money moved to energy, to staples, to other stuff. Now it's commodities turns again, not necessarily oil, but also energy. Uh, in that we will get rotation into food stuff, we will get rotation into staples, we will get rotation into defensive stuff. So even though I think we get a correction, I don't think we go below 715. And also, this is irrelevant what I drew here. This is like it could be a very slow one. Like we could While I think we do drop to the 21 EMA short term, like go to 760, this is next week almost for sure. But this could be like a very slow process. Eventually, it fades maybe when the month turns. Maybe if we get some catalyst at Jackson Hole, which is somewhere around here, and maybe like Warsh is bearish and says they will actually hike in September, and the market doesn't like it. This could be the catalyst where we actually break down. But I don't see us being very negative next week, even if money starts going away from semis and memory once again, and we have a peak in SNDK. I think that money rotates into something else, into food commodities, into metals, into gold, into something like that. And the market will generally be supported. So we will not get a breakdown very quickly and very dramatically. So I think we just go down sideways, start making lower highs here, but slight lower highs. Uh, and the breakdown should be coming. I don't know. This wasn't good. This supposed to be like this. So next week we go down, then we bounce again. Then beginning September maybe we do another breakdown, slightly lower. We do this, and eventually we fade down and get all the way here. But then we get another bounce and do something like this. For now, it's too early to tell. Uh, and I do too early for this part here that we could be getting. But for the next weeks, I think, like I said, we start making lower highs. We go to the 21 EMA on the on SPY, which is 760, and then we start building the lower highs over the longer term. And potentially, depending on what war says, we do get a breakdown, and eventually we go all the way to the lower side of this range, which could be here the 716, which is a um, ghost print which hasn't been tapped, but it could also be all just to like 730. So that's the optimistic bearish one. The negativistic bearish one is just like getting 730 and going back to the highs here. We'll see how it plays out. So because of the combination of commodities going up and potentially spiking inflation later on, the market should not be correcting in a very meaningful way this time either. But we have set a precedent of going sideways here. This could be like a fake breakout, and I think it's very likely that we only get this like what's the sorry what's the minimum correction? So minimum correction will be 6%. Maximum should be 785. The baseline. If if and only if something really bad happens and we go below this level, it will be like a double this, so like 15%, and we go to fill this gap here. So it would be something between 650, 660 and 670, somewhere in this area would be the target. Probably not at slow, but somewhere in this range where the gap fill begins and the gap fill ends. This would be the target if, for some reason, something else happens and it causes a big volatility expansion and the market corrects in a more significant way. But this is not the base case. Maybe Trump does something, maybe the war escalates in a very negative way again, but this is only if we get a catalyst. If we do not get the catalyst and we get this kind of lull in persistent inflation kind of setup, this is what's going to happen. The what I drew here in yellow. Basically go sideways, go down, go up, go sideways. And again, we need more information to determine what happens here. This is way too far in the future. It could be like this could be the beginning of a bear market, or it could not. We don't know quite yet, and it's too early to tell. I'll figure it out as we go from here. So this was kind of long. Hopefully, it explains the reasoning. The plan for my portfolio is basically I've been accumulating TLT even more. Then aside from this, I got some SPY puts yesterday, but not that many. Plan is to basically take profit if we drop to 760 next week, and I think that will happen. And then evaluate and see where we are. But aside from that, no plans for longs again for the foreseeable future. I'll see how things develop. Probably get some exposure to metals like XLB pull back here, but it's pulled back into the ribbon. So this still looks good. Given what I explained today, I don't think this is the playout. I think the playout is going to be more like we bounce, eventually hold and break out and do the next leg up to like 61, 65, something like this. I don't know exactly how high this will go, but things are looking quite negative right now. There's also like wheat ETF or corn ETF, which we can use to play this like commodity, this food commodity breakout. And I'm not, I haven't made the plan quite yet. I'm still thinking about it. Probably gonna wait for the breakout. Like we are in the fake out zone, basically, as long as it's in this area here, it could go back down, it could go back up. So mm, no idea how to play it quite yet. Staying in cash and playing like short-term plays with a very small percentage of the portfolio. But yeah, it is what it is. Hope it helps. Have a good one. Bye bye.